Today, we all are here to learn some basics of technical analysis. So, what is technical analysis? Why do traders use this technical analysis for their daily trading? And what are all the tools available in technical analysis that can help you out while taking a decision in trading? Now, going straight away to the introduction, actually, technical analysis deals with forecasting future prices based on past price movements. So there was a technical analyst, modern day technical analyst named Charles Dow, and according to his principles, whatever has happened in the past in stock market that tends to repeat itself even in the future. So whichever information you are seeing in the chart that already has the information of the past. So even if any news or any results are going to be announced with respect to a company, so the price has already discounted that information in your current session. So the first principle is whatever has happened in the past that tends to repeat itself even in the future. So technical analysis exactly deals with that point. S- It forecasts the future price movement based on the past price movements. How did the price move when the similar situation has occurred in the past? Now, in forecasting these prices, what is the information that traders look after? And the informations are price, volume, open interest, candle patterns, chart patterns, indicators, oscillators. There are many tools. So it depends upon the trader himself, like which information he is interested in. Now, first of all, let's look at this price. What is the price? This is the amount which a buyer and seller are having a mutual agreement upon. So buyer is ready to buy at certain amount and seller is ready to sell at certain amount. That we call as the price of the stock. Now it can refer to the daily level price. It can refer to the monthly level price, like what was the prior month's price. So we keep on hearing like people talk in this fashion. What was the high made in the last month? What was the high made in the last quarter? And when certain news about this stock has come, what was the price that the stock has fallen to? So these kind of things we keep on hearing in the market. So that is the first thing. Next comes the volume, like how many number of shares were traded in certain period. So if I'm concerned about the complete trading session of yesterday, volume means how many number of shares were sold and how many number of shares were bought. For example, if a person X sells 100 shares and if a person Y has bought 100 shares, the total volume here is 100. So it doesn't become 100 plus 100 as 200, but here the volume that got traded during that period would be 100 only. So it depends whether he is looking on daily time frame or if he wants to know about last 1 hour volume traded, like how many shares got exchanged in the last 1 hour or in the last 5 minutes. It depends upon the trader. If he's an intraday trader, he'll be very much concerned about the 1 minute performance, 5 minutes, 10 minutes, and so on. And if he is not an intraday trader, he'll look into the daily, weekly, monthly, or sometimes it can be an yearly chart also. So this is how volume helps them. If a large number of shares are getting exchanged, so that might trigger some buying interest or some selling interest in that stock. So that is the reason they look upon the factor volume of shares that got traded. Now in stock market, there are certain stocks which can be traded in the cash market, and there is another segment called derivatives also. Now let us consider an example of one such stock, which is Infosys. You can either pay the full price of Infosys and buy the shares, and there is also derivatives market in which the brokerage gives you certain margin to trade that stock. Now currently the market price of Infosys is 1127. Now, if you want to buy shares in the cash market, for each share, you need to pay the price 1127. And if you want to lower your amount, like invest smaller amount of money and buy a large number of shares, then you have something called futures market. In futures, many number of shares are clubbed together and you call it as one lot. Now in future, when we are seeing this derivatives topic, I'll explain you clearly there. Now at present moment, for us the definition of open interest is important. So the definition of open interest is nothing but when you are buying this futures contract, how many number of futures contract are still open in the market. Like if person X has bought one lot of Infosys shares and he didn't close his position yet. So similar to this person, there are many others available in the market who are having this open positions in the futures which they have not yet closed or which they didn't exit till now. So those number of contracts, we call them as open interest. So they are still open in the market. They did not close their position. Next comes the candle patterns. While we are reading about this price in the market, now for example, just now I told that Infosys current market price is 1127. Now by just hearing that current market price, I cannot derive any information on that. So the Japanese traders, what they did is they have clubbed certain prices like open price, high, close, and low price. So these four prices, when clubbed together into a single graphical representation, we call them as candle. Now, just after few slides, we'll be detailedly seeing about what is a candle, how many types of candles are there, and so on and so forth. So candle patterns is also one more tool that traders use to forecast the future price movement. And the others are chart patterns and indicators. In our future coming classes, we'll be seeing about these two. And I've already told that if a trader is intending to hold the stock only for a single day, he'll be very much interested in what was the price movement in the last 1 minute, in 5 minutes, 10 minutes, and so on. And if he wants to hold the share for a longer term, he'll be looking at what is the price movement over a certain day or certain week or certain month. So time frame is also an important concept when you are looking at a chart. So this is also one more important tool. Now there are certain assumptions in technical analysis. When you are dealing with technical analysis and when you want to take any action based on technical analysis, there are certain assumptions which you have to read. First thing is market discounts everything. So whatever the price you are seeing in the market as of now, that has already gotten the information which you didn't knew earlier. Now, for example, if Infosys results were to be announced tomorrow, and tomorrow if you see any the price that is being traded in Infosys, that has already got the information of that results. So even before announcing the results in the market, there are certain expectations on that stock. So based on the past performance of Infosys, even in this quarter or even in this year also, market expects certain performance from Infosys. So it also assumes that past performance is going to repeat in Infosys even in this quarter or even in this year end. So based on that, it already, if the market expects that Infosys is going to give a good result, even before the result season, you can see the price is increasing. And if market expects that Infosys results are going to be bad, so already the price will fall even before announcing the results. So whatever the information you are seeing currently in the chart, it has already got the information which you never knew. Next thing, price move in trends. So whatever the price you are seeing in the chart, it's not a random movement, but actually here the price is moving in trend. Now if you open the intraday time frame chart, you may see that candle comes here, candle comes there, price is moving here and there. So you think that it is a random movement. But if you go to the higher time frame chart, there you can exactly see what is the actual trend made by a chart. Let me show one such example. We'll first see the intraday chart, and then we'll slowly move to the higher time frame chart. So this is RBL Bank's intraday chart. You can see that price is moving here and there, and you're not able to determine whether it is in uptrend or it is in downtrend, since this is a 5-minute chart. Now let us slowly move to 1 hour chart. So here the price is now somewhat clear that it is moving in an uptrend. Let's move to a slightly higher time frame, which is daily time frame. Even here also there is some more confirmation that actually price had already moved in a downtrend, and it is now retracing a bit. On weekly time frame, it is much more clear. Since the time of inception of this stock, it was already in the uptrend, and now it is just in the sideways movement. The same stock, if we go to monthly time frame, the trend is much more clearer here. Uptrend and then a small retracement. So if you go into higher time frames, the trend will be clearer to you. Now this, from the starting point of here and to this ending point, we call it as a primary trend, and this small retracement which you are seeing here, we call it as a secondary trend. So secondary trend is always opposite to the primary trend, and within this secondary trend we have something called as minor trends. So small ups and small downs, that we call them as minor trends. Next, we have already discussed this. History tends to repeat itself. Now, why does history tends to repeat itself? Because traders have certain psychology associated with them. Now someone thinks about Infosys in one way, and the other person who is selling thinks in the other way. So everybody has got their own psychology, and according to their psychology they take decisions in the stock market. And now this repetitive nature of this price is nothing but the market psychology or the trader's psychology. Earlier, when Infosys results were announced, price has dropped. So a buyer or a seller, now in this situation, a seller would think, so even now the after announcement of this Infosys results, price might fall. So he'll initiate a short order on futures or options. And similarly, the other person who is buying, he'll think that no, this time the opposite might happen, and he'll initiate a buy order. So it depends upon what is their conviction about the price. And how do you derive whether this is going to happen or that is going to happen? You can take help of these chart patterns and candle patterns. These patterns will tell you what is the actual psychology or what is the actual thing that is running behind the price movement in the market.